Hi there, my name is Dazia and we're just going to go through the statement of financial position. This is a topic in the CSC course, the Canadian Securities course, and also in accounting and other type of courses. So in the statement of financial position for a company based on IFRS, we are going to look at the assets and liabilities and equity of the company. So it is a statement on December 31st or whatever is the closing date for the company financial statement. That is the day on which we're going to assess what is the value of the asset, what are the liabilities, what is the equity. So think of it as a house. It's easier to understand if you think of a house. Asset, the market value of the house, let's suppose it is $500,000 value, and the liabilities would be like the mortgage on the house. So if you have a mortgage of $300,000 on the house, then we're left with equity of $200,000. So if someone asks, what is your equity in your house? You would say, my equity is $200,000. So this is basically the concept, same as in the statement of financial position. What we're going to do is we're going to calculate what is the value of the assets and the liabilities, and we're going to, so assets minus the liabilities will give you the equity. Or you could also flip it around and say, okay, if I add the liabilities and equities together, this should equal my assets. So that is the other way of also looking at it. Liabilities plus equity, this should equal to your assets. So either way, you need to keep that in mind. This is what we're doing here in the case of the statement of financial positions. So we're going to talk about the assets a little bit more detail. The assets are mainly of two types. One are the fixed assets and the other are the current assets. So in the fixed assets, those are the items in the company which are not going to be sold, which are not going to change. So their example is PPE, which mainly they categorize it as plant, property, and equipment. So these are machinery, the land, the other products which are not going to be changed, which are going to be used in the company's activities on a regular basis. So the plant, property, and equipment are not going to be changed. However, in the statement, what we're going to do is we're going to take the value, the original cost of these items, and we're going to be minusing depreciation from it every year. If you look at my other video, I've explained FIFO and LIFO, and now there's also an average cost also being used for calculating the depreciation. Now mainly FIFO and the average depreciation is used more regularly. So from the original cost of purchasing those items, we're going to minus depreciation, and what we're going to be left with is called carrying amount or book value. This will be recorded on our statement. This is going to be on the other statement. But basically need to understand right now we want to calculate what is the value of the fixed assets, and then we have the value of the current assets. The current assets are those which are going to be converted into cash within 1 year. We expect them to be converted to cash for the company within 1 year. And these include, we have raw material. So any raw material which the company has purchased is going to be converted into cash. And we also have here the stocks, inventory, work in progress. So stocks or work in progress, inventory. So those items which are within the company services or products which are being worked on, and inventory is that product which is in the warehouse which has not been sold yet. So that is under the inventory. So and then we have accounts receivable and prepaid expenses. So accounts receivable, any item which is shipped out to the stores and which we have not yet received any money right now, that is also, accounts receivable is also a current asset for us now. And prepaid expenses, so any expenses that the company has paid out. For example, in example of prepaid expenses are rent and also insurance policies which you've prepaid for. These all come under current assets for the company. So these two main types, and then the third type also we have intangible assets. Intangible are those which you cannot really touch or taste or feel, but they are important for the company because intangible also have a significant value. So these include goodwill, So goodwill of the company, trademarks, patents, and other such items, brand name, brand, this is all a part of the intangible asset for the company also. So this is basically the explanation about the assets. So let's talk about the liabilities. In the liabilities, we have mainly two types of liabilities, which are the current liabilities and the long-term liabilities. So that money which the company has to pay off within 1 year is called current liabilities. And those which they don't have to can be medium or long term, depending on how much time they have to pay it back. These have to be paid within 1 year. Okay, so the current liabilities will be including such items as bank loans and overdraft. So if they have an overdraft facility, which they can use and they have to pay it back within a year or within a couple of months. Then accounts payable. Accounts payable is for like raw material that they have already received and they still have to pay the money for those raw material received. So that is a current liability which they have to pay within the 1 year. And dividend and taxes which are payable within this year. So dividend and taxes which are payable within 1 year. These are our current liabilities. In the medium and long term will be any bonds issued. The money we got from bonds are going to be long term because they are not to be paid yet. But if we have a sinking fund which is going to be paid off this year, a portion of it, that will come under current liabilities. So any part of the bond issue which are due this year, so that will be a sinking fund, will be included in the current liabilities. So we also have there the debentures. Debentures are also another loans which are long-term, will be under our long-term liability. So which is quite straightforward. And the third part is the shareholders' equity. Under shareholder equity, we have share capital. So under equity, we have share capital. The share capital is that money which is fixed. So keep in mind, this share capital is not affected by the share price. Think of it this way, that whatever the company has issued an IPO for, initial public offering, this is the original IPO. So if they issued it at, suppose, $40 and they sold, suppose they gave 1,000 shares were picked up. So it means that the company now has $40,000 which is going to be their share capital. This is going to be fixed. Now regardless of where the price of the shares go, whether it goes up or down, it does not matter. These shares are being traded between investors only. The company is affected only when they reissue more shares. If they're able to reissue the shares at a higher price, if they're able to reissue it at, suppose, $50, so that new, if they're issuing at $50 and this is at, suppose they issue now 500 shares, so $25,000 is going to be extra, which is going to go into their share capital, which is called contributed surplus. So if they issue shares at a higher price, it is known as contributed surplus, and this is also a part of the equity. So this contributed surplus and this share capital is a part of the equity, and this can be either, it can be preferred or it can be common, depending on the type of shares they're issuing. So there'll be common share capital and preferred share capital. The second part is also of this is retained earnings. So think of retained earnings as retained earnings is like a savings account for the company. Accumulated savings every year it will accumulate into the retained earnings. If the company has a loss, they're going to minus the loss from the retained earnings. So this is also money which they can use in their business on a regular basis. So this is basically the retained profits, the retained earnings, contributed surplus, the capital share, and also the foreign exchange adjustment is also something which, if they have foreign money in different foreign exchange, so foreign exchange adjustment can be plus or minus, so that will be based on the fluctuation in the currencies. So this is all the part of the equity, and in the case of the equity, we are looking at more in terms of what is the capital which is being used in the company. So think of it this way: in the statement of financial position, what have we done? We are basically looking at the current assets plus current liabilities. So this is both our liabilities. So these liabilities are basically used by the company, plus also the equity, the share capital, and the other items. These both are being used by the company in order, this is the capital which is used in the company, and these capitals are used to purchase assets, which are both, of course, the fixed and the current assets, right? So from the current assets, they are able to produce a product or a service, and from there they will get revenue or they will get sales. And once they get this revenue, then we move on to the statement of the other statement, which is going to describe to us how the cash flow is going to be done. The comprehensive income statement tells us what happens with this income, but for the statement of financial positions, we need to know what are the liabilities, what are the equities, and what are the assets. So this is on December 31st. So this has been an explanation, just a brief summary, but of course it's much more complicated than that. Have an excellent day, and I will also be explaining the statement of comprehensive income.